Hello everyone, I'm Sonu Iyer. Welcome to our IPO knowledge series. Today we will talk about employee stock ownership plans, a powerful tool for employee reward, retention, and attracting talent. When a company prepares to go public, it's not just about inviting external investors. Employee stock ownership plan can play a pivotal role by turning employees into stakeholders. In my opinion, a well-crafted employee stock ownership plan is a strategic asset that reflects on company's maturity, vision, and its commitment to inclusive growth. There can be various types of employee stock ownership plans, but for today, let's talk about employee stock option plans, ESOPs, which are also generally favored by SEBI. Then let me now delve into some pointers for any company looking to set up an ESOP plan. First up, how much to give, the size of the equity pool, and dilution. Are the promoters and the existing shareholders prepared to part with precious equity? That's the critical one. Understanding the impact of ESOP on the capital structure from a dilution perspective is vital, as it will ultimately affect the listing price. Then who all to give? All employees of the company may be covered, except independent directors, directors holding more than 10% of the existing share capital, and promoters of the company. On founder employees, there's some good news. SEBI, in its board meeting in June 2025, has actually approved an amendment to SEBI regulations, which will now help founder employees who receive such share-based benefits at least a year prior to the filing of the draft red herring prospectus to continue to hold and exercise such benefits even after being named as a promoter in the DRHP and the company becoming a listed entity. Then the next decision is when to give and the frequency of grants, whether it's one time or annual with top-ups. Then how much to give. That has to be linked with the potential that you have in terms of wealth maximization that the factor that you have in mind. The vesting period, SEBI mandates a minimum vesting period of 1 year. Otherwise, vesting period can be anywhere between 1 year to 3 years or 4 years, depending on the industry. The exercise price is the purchase price to be paid by the employee to get the share. This cannot be less than the face value of the share as per Companies Act. Otherwise, the companies can set any exercise price. Whether or not to set up a trust to administer the plan. Trust is needed for secondary acquisition of shares from the market for issuing under the plan, but you don't have to get into a trust right away. But trust is inevitable for secondary acquisition. Then finally, the success of an ESOP, in my mind, depends on effective communication, employee engagement, as also training employees around insider trading and corporate governance. That's all for today. Thank you for listening in.